You with my matching necklace?
Yeah. Mm-hmm. Hint, hint.
Hint, hint. I have to get a light or something because my room is so dark.
But you don't look dark on
You
here.
don't look dark.
Oh, really?
Mm-hmm.
When I look at
Mm-hmm.
myself, I look like I'm orange in my
Well,
picture.
we don't want that.
No, no,
Yeah.
no, no, no.
Because like Angie looks really bright in her office.
But I know what you mean. There are some tones, but I mean it's not dark. You're not. It's not dark in it.
Mm-hmm. Now, if we were meeting in person, I would share with you the 96 two boxes of 48 that my daughter brought home from Snickers, and I asked her, what do you think I'm gonna do with 96 bars of Snicker bars? So I posted on Facebook, and people have been coming by and swinging by my door, knocking and leaving. I just leave little baggies by the door. 96 bars of Snickers.
Snickers.
But is it? She's selling it for a school
No,
project or something?
she works for M&M's.
Oh, okay.
Wow.
Okay, looks like we're live.
Okay.
Let's see, do we have 1, 2, 3, 4,
Yep.
5, 6, 7? Yes, we have eight. So thanks everyone for making it today's investment meeting. I would like to call the investment meeting to order via roll call.
Angela Banks,
Here.
Hey, Angie.
Christina Bennett,
Present.
Joseph Clark, Darnetta Klinkscale,
Hello, it's Darnetta. Yes.
Lewis Cross,
Yes, present.
Sheila Goodwin,
Present.
Donna Jones,
Here.
Yvette Levy,
Here.
Bobby
Hey, Yvette.
Richardson,
Present.
Albert Sanders,
Here.
and Justin Stein.
I'm here.
All right, so we have 10, so definitely a quorum.
Thank you. With that quorum, I'm going to turn it over to Kristen, where she can either share her screen. Did everybody receive the material?
No.
The electronic?
Yes.
Who did not receive material?
Oh, I have the material.
Oh, yeah, I have it.
Well, it's on the screen now. And by the way, Sue, I just received today my board packet for Monday's meeting.
Holy cow, I'm so
Yes.
sorry.
So no, it's the mail here in St. Louis. So, Kristen, you have the floor. Kristen, you're on mute.
Yep, you're on mute.
Okay, that's going to be the theme of the year. You're on mute. I'm just talking away. So great to see you guys' faces. And this is the last investment committee meeting of the year. So let's move to it. Maybe we can, okay, so let me ask you. I think I sent you the performance. Did you want to go over performance?
This is, well, we have what? We have November performance. You sent me
Yes.
I would prefer that we go over everyone has received the performance. I prefer that we go over the pacing plan so that we don't lose track of time.
Sure.
And then everybody can receive the performance. And if we have any time, we will go ahead and get a quick snapshot of November performance.
No worries, that I'm happy to do that. So this is the pacing plan. And so we have done, it's really 3 pacing plans in one. So we're going to review your private equity, private credit, and then private real estate. The point of this is to give us really a baseline blueprint for how we're going to proceed. We will still go through and look at our asset allocation, but I don't believe that there's going to be a huge amount of changes. And every year that we do a pacing plan, it's for that year, but we give guidance going forward. So I think that this will help. And like I said, we've done these every year, and it just they rarely change much, and so it would be on the fringe if there was a change. So we thought, given there's some great opportunities out there, this made sense to get the blueprint on the table, so we can start thinking about investing in managers. So with that, maybe we can move to the next page. And this is everything I just said. So we can move following page. Here's our private thoughts. And these are a little dated. We will have another set coming out. This year, we're actually doing everything, our actions and the assumptions by or for December 31st. Typically, it is as of November 30th. But as you know, because of COVID, we've actually done this several times this year. And so we felt fairly comfortable to move it to the, the totality of the year of 2020. So with that in mind, sort of the high level message is this. We need to be very strategic about the markets that we look into. Not that we are typically, but we've moved out of a late market cycle into more of a COVID shock cycle, if you will. There's a lot of distress, and I don't mean distressed in a negative way, but distressed opportunities in the market, both within private equity, private credit, and real estate and real assets. And so, and we're actually not dealing with real assets, but giving that information, we also need to be mindful that typically whenever you have a shock to the system, as we have had, the vintage year that follows oftentimes tends to be very strong. Again, that's not a promise, but just what we've seen historical. So we really do not want to not invest in this coming up year. Also, the duration. So normally you invest in a private market, in over time, those assets are called down. So what I mean is when they start the fund, they don't take the totality of the dollars. If you invest $10 million, they don't take that $10 million right away. What they do is say, okay, you're committed. We're going to now see where opportunities arise. And as they move through seeing opportunities, they may say, oh, we saw some great opportunity. We need 1 million of that 10 million. So the remaining 9 million remains in your portfolio until it's quote unquote called. So that's just an important delineation. It stays and remains within your portfolio. So it's not like sitting in cash. It's still working for you from an investment standpoint, as long as we don't have it in cash for any reason, but we don't. And so I think that that's important to note. And then also the investments and drawdowns are just a little slowed given COVID. So that's something we expect. The nice thing is when you're invested in private markets and you have these types of shocks to the system, it does damper sort of that volatility because it's not mark to market. Mark to market means it's not daily liquidity or daily pricing. That pricing comes over time. So we have indications of the pricing through the IRR and the like, but we don't have, it's not actually sold because as you remember, it's a private company. So
Kristen,
that's sort of how,
can I
sorry?
interrupt you for a second? I want to go in and just make sure that everyone understands something you said, which is while we have vintage years that we've invested recently in, and we can go through that and you'll show it, is that we still have money to be called from those investments out there. And that is something that we as a board do not get involved in when those are called. Our executive director makes those decisions on where to pull the excess funds from based on our asset allocation to get us back to our ideal allocation that we have. But I wanted everybody to just make sure that they understand that while we invest in these markets, we have a liability per se that we owe these companies money, and that is managed by Sue when she's looking at pension payments as well as when cash is called. So those type of back office decisions we are made abreast of when something is called, but we just always want to know what that potential amount is in a given year, and just for our educational purpose to keep coming back to that, so that we keep in mind what we owe to some of these investments.
And we'll show that we have that in some of the charts. And just as a reminder, because as Christina has aptly discussed around the commitment level, and I gave an example, if you have 10 million, they may call it, slowly. The reality is that we are basing our allocation on that $10 million in investments. So we actually have to over. So while let's say your target was 10 million, to actually get to that 10 million, you may have to do something like 20 million because we're compensating for the fact that it's being called slower. So that's the way to get the level of exposure. Again, you have a relatively mature program in most of the, in particular in private equity. So we don't, you know, we have the ability to balance that. So we really look at the cash flows, both drawdown, anticipated drawdowns, as well as, you know, realizations coming back into the portfolio. And there are some times where you, and I'll leave it here, where you may have invested $10 million and the fund actually only calls back or draws down 5 million because they actually have earlier investment returns that make up the difference. So they never actually have to ask you for the totality of the total investment. And so that's another important nuance. And again, these are some things that we handle, we'll handle, you know, help Sue handle, but it's just good to kind of know that information. As it relates to the actions, which is that bottom path, that's really just talking about the areas that we see opportunity. They're going to continue to see opportunity in private equity, in private credit, as well as real estate. And we have some specific areas that we really want to focus in on those areas, in those strategies. So with that, maybe we can move on. Yes, so these are going to be the private equity and private credit components, and this is actually going to show you where we think that there are opportunities. So green means positive. We think that there's great opportunities. Gray means more neutral. So that doesn't mean that you don't want it. We want you to have sort of a benchmark weighting to it, right? We like it, but it's just not our highest conviction. But especially when you're starting out a portfolio, you want to make sure that you have all the components, even if it's not the highest octane opportunity at that moment. So when you look and you see things like U.S. large mega buyout, that's great. It just means that you know, an exposure is great, but we're not going to over tilt that at this junction. However, if you look at secondaries or like U.S. growth or European growth, all of those are green, U.S. special situation. And so by the level of greens, you can kind of tell there's some nice areas and pockets to actually find value, we believe. And so our research team really focuses on trying to find a plethora of ideas that fall into those categories that would add value to your portfolio. So when we think about your portfolio, we're going to look at it from an asset allocation standpoint on, okay, how much of X, Y, and Z? So how much venture, how much buyout, how much European or global that we want co-investment or secondaries, special situations and the like. What do we think the optimal mix is? Then two, we'll then also look at the managers within that and find, you know, viable candidates. And so we spend a decent amount of time on that piece of it. On the private credit side, you see that distressed, opportunistic credit and niche lending are the areas that we would likely stay focused on. You all have MC credit, which falls into the niche lending area, which is great already. U.S. direct lending is something that we like. The Monroe would be a U.S. direct lending, which you have in your portfolio. It doesn't mean that we don't think that they're going to add value. It's just not our highest conviction, but you have exposure, and which is good. And 4 or 5 years ago, U.S. direct lending was bright green. So it's doing exactly what we anticipate. We're not always going to put all of our eggs in the same basket. We are always going to recommend that you invest in private equity and private credit on an annual basis, but those pockets that we see value add may change. And so that's how you end up with a diversification. So with that in mind, we can go to the next page, Sue, please.
Wait, I have a question.
Yes, ma'am.
Could you go back? So a couple of things, the red, how do you, there's 3 of these at the top private that have red outlined on them. And it says here negative. So how do we interpret that, or what do we do with that?
Sure. So that really means that while it's still a neutral, it's been trending down, but it's not a red yet. It's not a negative.
Oh, okay. So
I guess my
the
interpretation-
legend says that
Right.
red is negative.
Right. So
It's
If it were-
trending down.
it's trending down. So otherwise, we don't have any reds on this, but a true red, the whole box where all that gray is would be red as well.
So are these some of the ones that we need to pay closer attention to?
It's just an area we're not recommending that you do any, you may not, if you already have it in your portfolio, we're not recommending that you do any new
Okay.
investments.
And so
right
you
now.
said a bright green. Are there 2 levels of green?
There are.
Okay.
So you see the green that has the
Uh-huh.
green in the background as well? Like early
Oh
stage
yeah, I
venture.
do. I do.
So that's going to be the highest green. And then
I
if you look
see.
in the middle column and you see, let's say secondaries, it's green,
Yeah.
which means high conviction, but it's gray there. So it's not quite as high as the early stage venture.
Thank
But
you.
it's still a very, it's very much bubble to the top. So those
Right.
are just slight nuances,
Mhm.
but they still fall into the category of the larger box. Okay.
So
Thank you.
Kristen, so these are all the baskets in private equity that we could potentially invest in.
Yes.
We are in some of them. We're not
Yes.
in all of them. And just because some of them are gray or red, we may or may not be in those. They're just saying that we may not jump into U.S. late stage venture at this moment, this next year. So
Correct.
you will identify on the next slides over which ones we have that are in these specific buckets.
Mhm.
Okay, thanks.
So, yeah. So at this point, you see what's in private equity and private credit, and we do have the what am I trying to say? We have the legend at the bottom, so that helps you. And then also, you know what? Just to delineate that even further, when I'm talking about kind of that gradients of more or less. If you look here, it says front, which is going to be the bigger box. That's post-pandemic. So that's where we're on our way to now on a prospective basis, because we're looking forward, right? Pre-pandemic viewpoint. So you see where there's red, that means that it's also come a little bit more into favor. Okay. So that's just good to know. Okay, so let's move on. Thank you. So this is just going to give you your current strategy. And as you can see, you want to know where your basket of private equity is presently. And so when you see that pie chart, I think is the easiest way to kind of get an idea. You see that the light blue is going to be, what is the light blue? Sorry, people's heads are in the face of the light blue.
It's secondaries.
Huh. Yes, that's what I thought. So in my screen, it's funny. It looks light blue, but then my actual legend says gray. So I was like, I was thinking there was a mismatch on the colors, but I see it is a little bit. But yeah, so okay, secondaries is where you have the largest concentration. And then you have fund of funds. That's a diversified portfolio, which we believe in. You've done well within your portfolio. And then distressed and buyout. And I should turn back to the secondaries for just a minute. Secondaries, once again, is going to be a diversified basket, but you're buying into it at a later period of time. So that means it's already been like a fund of funds or funds, if you will. They've already, it may be, or 2020, it may be 2017 or 18 vintage, which means they've already started to invest, but you're investing at that time. The reason those are nice, and we've done that to kind of catch up in some instances in your portfolios, because you actually get to see some of the underlying companies. Oftentimes when you start in the beginning with an investment, they don't have any investment. So you're looking at what their past performance has been and the skill, et cetera, on how they've done things, and you're extrapolating that to the future. When you have a secondaries, you actually have a portfolio that you can look and see how it's doing. And you might ask, well, how does that happen? It's oftentimes an asset pool has decided for one reason or another they cannot keep the investment. And it's not off, it doesn't mean it's a bad investment. It just may mean that they're over allocated. It may mean that they need liquidity. It can mean a plethora of things. And so they go about the business of selling their portfolio into the secondary market, of which then makes it available for another asset pool to buy it, on that secondary market and yield the remainder of the returns. Okay, but again, you get the purview of being able to see what you have, which is nice. The returns don't tend to be as high as if you were the primary or the first in, but also the risk is going to be less, right? Because you also know what you're getting into. So I think that's just good to know. When you look at, you can see it by numbers, what your breakdown is what you actually have in it and what their total exposure is. And then that's light green column will tell you kind of your current valuation or net asset value. So that's really what it's worth now. And just as we talked about that drawdown structure, the capital to be funded. So as in buyout, you see that you still have $2.6 million to go to that area. It hasn't been called yet. Okay, so it's sitting inside of your portfolio generating income. And then we have our vintage year commitments. And so this just goes through 2006 all the way out to 2018. So we're due for private equity.
I'll talk to you later, Marcia. Thanks.
All right, maybe we can move on.
No, I can't be.
Oh, no.
So can you mute everyone, please?
I'm hoping this doesn't go very long.
Justin, okay.
Okay, so was this the next page, Susan? We didn't skip. Okay.
Yep.
So this is just, once again, going to break it down in another way. I won't spend too much time, but the nice thing is it can show you from the names that you're in from the various segments. So buyout, distressed, fund of funds, and secondaries. So Landmark, as you can see, is a strong secondary manager that you've used a number of times. Your fund of funds, Mesro and Fort Washington. Distressed is going to be SVP and Singular Gulf, and then Vista Foundation is your buyout. And so again, strong firms, but now segmented amongst the sub strategies that they're involved within private equity. Can we move to the next slide?
Can we stay on this slide?
Sure.
Which one was I thought it was Singular Gulf, but it's not. Is it SVP that we're still waiting? So that one, can we footnote here? Isn't this the one that we invested, but they closed their shop and we only invested $500,000?
Yeah.
So can we footnote that really, because it looks like capital to be funded is 4.5, but really it's not, because they're no longer taking our funds. We're winding that one down.
Put a note there.
Okay, I just don't want somebody to think that we still have 4.5 to be funded on this fund. And just for history purpose, we invested in this fund. They came in, presented, we thought it was great. We committed $5 million. We invested about $500,000, and then they couldn't finish their fundraising and complete it or really utilize the capital going forward. So there's really nothing. I'm not sure if there's anything left outstanding on this one, but this one just has to be footnoted that, that 4.5 is not accurate.
Okay.
Thank you.
Your total portfolio assets are $806 million, and you can see the total private equity assets, total private equity capital be funded, and the total private equity exposure is $52.5 million. So that gives you an idea in dollars and cents. Our private equity allocation is 7%. So that's the target. We're not there yet. So we're still working towards it, but that just gives you an idea. And then what you can do is the next two columns, these are really just statistics.
Does this show where we are if 7.0 is our target?
Mm-hmm. So your total private equity to total portfolio assets is 3.1.
Oh, okay.
The
I see
total
that.
private equity exposure, which is slightly different to the total portfolio assets, is 6.5.
Okay,
Okay, and so, and then the nice chart on the bottom really shows you relative to the total portfolio, to all of your assets, where you are. So the green is going to be the private equity component, and then the blue is your fund.
okay.
And
Thank-
what we're showing is over time, the growth. So you have about a 3% growth rate. And at some point we'll need to get some, clarity if that continues to be appropriate, given some of the new, well, we'll just have to see, given some of the new findings that you just shared with me. But right now we have you at growing at about 3%. So
You know what? This is one of those charts, I think, that we could have some training on. Because I know it gets a little confusing to me. And so we may be asking you to do that at some point in the spring.
sure.
Arnetta, I'm making a note for
Okay,
us to
thank you.
take time to go over that and try to
Oh.
squeeze it in 2021 to review
Great.
these ratios for,
Okay. Good.
and that will
Thank
give Kristen time to update these numbers. They'll change slightly without that $5 million number in that last portfolio that I just mentioned.
And I
I'm
had a
making a note.
question on the 3%, Kristen, that you were talking about. Is that what, a long-term average, or what is, over what period are you providing that 3%?
That 3% growth rate,
Yeah.
that's an annual growth rate. And so the reason I was saying we'll have to look at it is because of some of the changes, as it relates to the growth of the portfolio, given that your liabilities are a little bit larger than what, well, could be. I mean, they could be double, right? You said they may go up to 400 million.
So is this a given point in time, our equity? So is this as of our equity assets at the moment to our core portfolio as of November 30th?
It
So is this
is.
a point in time?
That's a point in time. I thought that I was being asked on the right, if you scroll over that other chart, your net growth rate is 3% a year. And what I'm saying is if there's a change in the liabilities, then the growth of the portfolio, that may have an impact on whether that growth rate is, because that may mean that you're giving out more on an annual basis, which may stunt that growth rate. That's something that the actuaries can help us with, but I'm just thinking through, depending on when this becomes permanent and applicable to your fund, it has an impact.
And this has nothing to do with this net growth rate has nothing to do with our actuarial growth rate assumption of 7.5.
No, that's your actual, your hurdle is
Okay.
7.5. So, and then we projected over multiple years. And so the components of that is what your beginning NAV, so that's net asset value, just the valuation, what it is. Today is 806. Your yearly net growth, which is that 3%, we're saying is about 24 million. So that means your total NAV is 830. And then your target private equity allocation is 7%. Which translates to 58.1 million. Okay, so that's where your projected is. Okay, and you do that for each year. And so we'll have a starting, if you look at the numbers and follow them, 2022, again, 3% net growth rate. So we're starting with that 830. So the ending balance of 2021 now goes to the beginning balance of 2022. And then you're still growing at 3%, which is 24.9 compared to the 24.2, because it's a larger dollar amount that you're doing that 3% on. And so then that results in 2022 a ending balance of 855 million. and you follow that path, if you see. So now that's the ending balance of 2022, but then it's the beginning balance of 2023, and then you follow the same thing. So I'm just, again, we'll do a much deeper dive, but just to give you some perspective on that. And then the bottom chart really is showing, once again, the same thing, but now it's doing it in a chart format. So we're really giving it to you several different ways. Because some people will learn better and see better and understand better visually, and others just want to see the numbers. So that's our effort to be all encompassing.
Okay, I have a question. I'm looking at a total projected portfolio, and you were saying from year 2021 to 2022 is always a 3%. What if it's not a 3%? Will the market change? Will it go down?
So that's
I
not
know it's projected. I know it's projected, but is it guaranteed from 2021 to 2030? Is it always 3%?
It is not guaranteed. We have projected out. So that goes back to my point of saying, given some of the changes in your portfolio, you may no longer have a 3% growth rate. You may come to me and say, it's a 0 growth rate. You could come to me and say, it's a negative 0.5 growth rate, which means every year it's getting smaller and smaller. So that is based on the information that you give me. We model this as if the growth rate becomes static. But again, at the this is why we look at these things on an annual basis, because at any point in time, you can tell me, actually, that is no longer a realistic assumption. And then we must change it. So this 3% is not based on the market per se, I should say. This is, I mean, it's based on the growth of the portfolio, yes, but it's a combination. It's not based, it can change, and it is, if your liabilities, as I mentioned, are higher, that's going to have a change on it as well.
So Kristen, just to, I guess, to bring it back to give Bobby a big picture. So this is talking about our private equity portfolio, right?
Right.
So this is only, when you look at our total portfolio, it is 806 million. But when we look at like all the other funds that we have that are not in private equity, when we look, it's kind of like splitting our portfolio into two parts: private equity, and then all the equities that we have in all the other mutual funds and funds that we go over every month, right? And those, the ones that we do on our performance review, we look at all the managers, those have daily liquidity, and we can look at them and look them up and see what their value is. The private markets is, it's hard to get a daily value. You can't get daily values out of them. So if we said we were going to get 7%, just to play with numbers, for our entire portfolio, all the returns, this is saying out of that 7%, your private equity is hoping to contribute 3% of that 7%. Am I correct, Kristen?
Yes.
And so this is just looking at private equity portfolio, and it's a 3%. I don't know what 2019 and 2020 was projected at, but this is only this part. And then we have to look at, that's why we have to look at both private equity and our equity portfolio, so that in the combination of the two buckets of assets, we come up with what we hope to be 7.5% based on what our actuary thinks we're going to get. So that's why I think, yeah. So this is looking at just 806, but it's really out of the 806, this is only one half of the bucket that we're looking at.
Okay, thank you.
I have a question. The 3% is that a return or is that allocation?
It's what we anticipate your portfolio, your total portfolio growing over time. So that could be a combination of returns. It can be a combination of contributions. It is, usually it's the actuary usually has a growth rate that they determine that your portfolio will have. Okay.
Okay.
All right.
Just 7% of our total portfolio.
Well, yeah, I mean, unfortunately, the numbers are very close. So you have a target of 7% to private equity, but you also have a 7.5% bogey actuarial rate of return that is expected on your investments. And remember, the growth rate is going to be, the reason it's not just that return, it's also going to be net any sort of liability. So it's, let's say you get 7.5%, we're saying that potentially 4.5% of that is going to be going to liabilities and paying other stuff, and that your principal net is going to grow 3%. But again, if the liabilities are different now, which it sounds like they may be, that could impact that number. Okay.
All right, thanks.
You're welcome. Maybe go on the next page.
Yep.
Okay, so this is a great slide. I think it's a little busy, but ultimately, and maybe go down just a little bit, Susan, the other way, so they can see the legend. No, that's okay. Actually, I was saying the other way, but that's okay. Go back down. Yeah. Okay. So when we look at this, it's, you know, just to get an idea of what we're talking about here. So the green is going to be new private equity. So the dark green is existing private equity, uncalled capital. Okay. And the dark blue is going to be existing private equity NAV. So the blue is what you got in the ground. It's already been invested, and what is that value? That green on top of it, if you're looking at 2020, is going to be what has yet to be called. So it's still sitting in your broader portfolio. It's not in your private equity portfolio. So this is why we have to have an over allocation. That red line, you see that red line? That is your target. And the dotted line is going to be what we believe you have to commit to get as close as possible to that target. So that's why we say over commitment, okay? Any of the, I'm going to call them shaded versus solid areas are just that. So the green shaded is going to be the new private equity that's called versus the existing, which is the darker, bolder colors. And then the blue shaded is going to be the new private equity investments. So again, the difference between solid and shaded is solid is existing, shaded is new.
So when we look at this and we see the shaded in 2030, we see the shaded, which is so different from 2020.
Yes, because your portfolio, your program has grown, but it's not invested at that point yet, right? Because the likelihood that any of your investments from 2020, they will have realized and they won't be in your portfolio anymore. Now, there may be some 2026 stuff in there, but this is because, you know, we're basing this on 2020. We're not basing this on 2026. So the shaded is going to be new investments that are in the portfolio or new capital that needs to be called down, that's uncalled. And the solid is going to be existing. So not new, but existing assets that are either in the portfolio or going to be called.
That makes sense.
Okay. And so I would say the bottom part is now we're just looking, once again, it's telling you what that chart just said is saying so that you can see it in the numbers. And then it's giving you that 6.5%, which you saw on the preceding page, which would be your NAV, the current value in the ground, plus any uncalled capital, okay? So we can, this is again, just once again, giving you an idea of where you stand today and how we're projecting this forward. You can move forward now. So now, once again, red is going to be your projected net asset value. Talking too fast. The green are going to be your commitments. And so you can see how your commitments are flowing from 2021 out to 2023, you're 2030, excuse me, you're really vacillating between 16 to 18 million. 18 suggests that your portfolio gets a bit bigger. And again, if we start to see a negative growth rate, remember your growth rate was at 3%. If we see a negative growth rate, that is going to flatten out. It may stay static, or if it's starting to eat at your principal, instead of it staying static over time, you could go from 16, 16, 18, 18, 15, 15, 14, 14, 13, 13. What that means and what that says is, unfortunately, you're starting to run out of money. So these numbers are going to be based on what your principal amount is. So right now we're basing it on about 806 million. If you go down to 700 because you have to pay out more in benefits, then you're no longer going to be giving 16 million at 7% because it's a percentage of total assets. Additionally, if it's going down, I may have to come to you and say, listen, your principal, your corpus is going down. You no longer can afford to have a 7% allocation to private equity. I may come back and say, you only can do 5, or you can only do 4. And so there's 2 levers there that could make that number go down. So I'm doing a little bit of education since this is the main thing we're going over today, but you'll go over this again so you kind of hear it multiple times. But this just gives you, again, that committed capital is based on the principal and that growth. And so as you see that number go up to 18 million, that's saying that, hey, the principal is growing. And as you remember, 3%, we went from 806 to 830 to 855. That's all being taken into consideration here. So again, if we go from 806 to 830, 855 to 700, it's going, that shape is going to go down as it relates to what you're going to be putting in. So I'm not saying that that's what it's going to do. So I don't want you to think gloom and doom, but I'm just giving you perspective as relates to what it is. So you have your commitment, projected private equity, NAV versus the total plan assets. And then as you see, we're still trying to get to that red bar. We really aren't getting to it until 2028. It takes a while, because you want to keep what we call vintage year diversification. So we don't want to put all the dollars in on day one or in 1 year, because we want to diversify the years, because that's another, you can have a bad year. And while I think 2020 and 2021 are going to be good years, you still don't, I mean, that's likely, that's not a guarantee. So we want to mitigate that risk.
And Kristen, one thing too for trustees to look at is take this information and just look at what we've committed in the past. And sometimes in the past, based on our financials and where we were as a percentage of the portfolio, we used to invest in one manager at 15 million. As our performance and our liabilities increase and based on investments, we may not be able to do those one large, commitments anymore. We may have to do, where we used to do $3 and $5 million allocations to some of these funds, so that we can get, the variety of baskets that we're looking to get into, and given, what our consultant sees is where we should be placing our assets in the next couple of years. So, I just want people to look at historically, that we've given some large ones $15 million allocations and $10 million allocations, and we may not be able to do that going forward based on some of our financials in the next 5 to 10 years.
Yep. Okay, let's maybe move on. Okay. So now we're just telling you, again, a different way to look at the data. Private equity capital calls, so that's that drawdown, is the red. The green are the distributions. So as your capital is being called, you do have a mature program, so we're expecting some distributions as well. And this is how you have that J curve as well. So in the beginning, you have capital calls and fees that are coming in. So that's going to be below the 0, if you will. And then over time, you start to swoop up. So because the capital calls the distributions, excuse me, are exceeding the capital calls and the capital calls and fees combined. So that's where you get that J curve. Okay, we can move on. So that, okay, before we say, now that was your private equity. So now we're moving to your private debt or private credit. I like to use credit to not get confused with senior lending, but people still say private debt. So private debt / credit, okay? We're gonna do the same thing here. So you only have 2 types of strategies, direct lending and total, mezzanine. Your current NAV is 25 million. If you can look here, you can see your private credit exposure, 97% in direct lending. That's going to be your Monroe of the year. And then you have mezzanine, which is going to be, I think, Smith Wiley Pelham. We haven't done mezzanine in a very long time. They're not as much in favor at this, or haven't been in favor for years and years and years. And that investment is pretty much wound out. I mean, I'd have to look and see. It's either, I think it's 2007 actually. So it's old. Okay. And so the new investments that you have are Brightwood, MC Credit, which I mentioned, very interesting. Actually, they're about to close. We're still, it's a best idea for NEPC. Complex does well in this environment. And while you all invested in it before we knew we were going into COVID, this would be one of those that someone would say, good call, knowing what we were going with, and then or what we were facing, excuse me. And then you have 2 Mezzaro. They've done great for you. That's that private debt, senior secured lending. And while we had the gray sort of red highlighted box, they've done very well for you.
And if you Monroe, not Mezzaro, Monroe.
Monroe, did I say Mezzaro?
Mm-hmm.
I'm sorry. Monroe. So, and you can see in your paid in capital there, you have 8.5 million of a $10 million allocation for 15, and then 7.8 for $11 million commitment in 18. The other one was 15. I'm sorry. So you can kind of see, when you look at your numbers here, how in the current valuation actually, and then the total value, you can see where you've added. I think actually it'd be nice to go to the next page. You can start to see how this really breaks down. So again, this is the exact same thing, much smaller level. That's because your private credit is only a 3% allocation. So 7% to private equity, 3% to private credit. So in totality, that's a 10% to private equity like strategies, okay? And so we still have that 3% growth rate. So that's going to be stagnant, and that would flow. If something changes, we'll update it. And maybe we can move on. And once again, this is the same chart. So you can kind of see how much you're committing every year. Yeah, that just gives you an idea of where you are every year. Just making sure there's nothing that I'm not going over in these charts that's here. Okay, so same philosophy each year. And so what we want to do, and we're making sure, is that we can afford to do this, and then what that dollar amount we're going to actually give on each year. So if you keep going to the next page. So now this tells you what you owe, not owe, but what we should be committing. So 2020 is 5 million. And so this is going to have to roll out a little bit because we didn't actually commit anything in 2020. So we're still doing a 2020 commitment, but it's December, so nothing will happen. So we'll have a little wiggle room to possibly do more in 2021. It's fine if it had happened at the end of the year, or even if we had done this in August, those funds may not actually be closed yet. So there's no huge concern about this. This is really a guidepost. It's not absolute. We want to know the trajectory that we're going. But that point being, look, we got about 5 million for 2020 and then 10 million for 2021. So if we want to do a little catch up again, that would be close to around 15 million, because that's taking care of 2 years. And then you're kind of at that $10 million static until you get further out to 2030. And of course, as time goes on and you get further away from today, it becomes less certain, which is why we do this every single year to capture any changes. Okay. This is going to be the capital calls, which is the red, and fees, and then the distributions. As you can see, the J curve is much more flat, and that's because private credit oftentimes throws off income, and it has a shorter duration. So that means even though you may not have any sort of realizations per se, it's throwing off quarterly income like a fixed income instrument. Okay. And then of course, its time horizon is not going to be as long. So it's anticipate 5 to 7 years. Private equity could be anywhere from 10 to 12 years. Okay. All right. Real estate, and these will go faster because they're very similar now that you have the data. Okay. Real estate, you have debt closed in. That means, private, longer duration. Current NAV is 4.9, capital to be funded is 5.6. You know what, let's move down here. I think it's getting a little bit more interesting here. You can see your existing real estate funds. You had 1 in 17 and 1 in 18. We just started this program. So before that, we had only what we call open-end real estate, mostly core. We're trying to whittle, we should be, and we'll make sure that we're still moving that down, dialing that down. So really getting out of the core and moving more into the value add. Eventually, we can replace the core, the UBS Trumbo core, with a private market core. But as it relates to conviction, we have more conviction in non-core real estate. So that's going to be your value add, real estate debt, and opportunistic. All that falls into the non-core type of real estate investing. Non-core is going to be a little bit more high octane on the return component, as well as slightly higher on the risk barometer as well. But we believe generating stronger returns over time, risk-adjusted returns. So we don't feel that we're doing anything risky. And then right now, you see your portfolio exposure has 100% debt closed in. That's because Elm Tree, which was your triple net release, they were able to exit and gave you a really nice, investment. And so that's why that's not really showing up anymore.
Kristen, can you do me a favor on this chart as well when we get it updated? When we look at Elm Tree, and it says capital to be funded at 2.5 million, realistically, that's not going to happen.
Right.
So it's skewing a little bit of the numbers on capital to be funded, but that should be really 0 or 0.5 or whatever. But I don't think that they're going to call any more capital on that 217 fund because they're winding it down.
You're absolutely right. We tend to report it still on there because in the off chance that something changes, low probability, of course, but let's say something did change, their fund is not actually shut down yet. Do you know what I'm saying? So there's the outside possibility. I mean, very, 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 very slim chance that they have another investment that they want to utilize for, and they could call that money, but they won't. But I'm just saying they could.
Well, yeah, because they're already
so we
on
have to,
another fund.
Huh?
So I said they're already on another fund. So I guess my thinking is the probability of them calling this fund versus the new fund.
It's probably non-existent.
Okay.
All I'm saying is that they haven't closed out this fund. We're really,
Okay.
we're talking about a technicality versus reality of what they're actually going to do.
Okay.
Okay. But as soon as they close that out, that line item, it's a completed situation. So, okay. Let's go to the next page. Okay. This is the same thing, kind of very similar chart. It's just the green is now going to be highlighted for real estate, not private equity or private credit. So I won't go through all the different numbers here, but you can see how it's growing over time. Next slide, Sue, please. And again, the shaded is going to be new, blue and green. The darker solid is going to be existing on green and blue. Blue is going to be currently invested, and green is going to be uncalled to be invested. And so you see that we don't actually get to our bogey till 2026. Okay. And now finally, what we want to see is what is our dollar amount going to be for each of these investments. So real estate, we're looking at 15 million in 2021. So they actually, unlike the last slide, they said, Kristen's not investing, St. Louis is not going to invest anything in the last 2 weeks of December and get that through compliance and negotiating. So they just went ahead and did it, rolled it out to 2021 as if we did it in January, which is fine. So we got a total of 15 million in 2021. And unlike the other charts, if you notice, we're really close to being at the target. You see how that red line is there. So. Okay. And you know, the nice thing about this one, so slightly different, if you look at the bottom here, you can actually see where they want you to actually do those dollars. And again, we can tweak that a little bit, but really what we're saying is, you know, real estate debt is the place to be at 15 million for 2021. But again, you know, this is a guidepost. So once we look at the funds that are available, then we'll make a determination. If we put all of those dollars to real estate debt, we may want to do some more triple net lease. I mean, there's, you know, other things that we can do. Okay. A little more choppy. But essentially, this is kind of the way the cash flows are. And you can see more clearly. And again, this is because we're new to real estate, private real estate. So this is more of a immature line versus private equity as an example, which is a mature program. So you really are starting off kind of with nothing pretty much. And so those drawdowns are going to be, you know, taking up, drawdowns and fees are going to be taking up most of what's going on in the red, and the green will not offset it until later on to start to go up when you start having realizations. And remember, green are the distribution. So you have to go through the life cycle to get there. So this is not unexpected. Okay. So that's pretty much it. I don't know if you have any questions. It's just the appendix that we have left.
Can we go back to that last slide?
Huh?
Yeah, to this slide. So I guess I'm just wondering, given the state of our overall fund, and am I understanding you to say that, I guess the projected real estate, we really won't see the great benefits until 10 years down the road?
Yeah. Yeah. I mean, well, you'll start to see benefits, but it does take a while for these programs to get up and running. So this is exactly what you had with private equity when you started.
Right. So I guess I'm just wondering, kind of out loud, and Chris helped me with my thoughts here. But given the state of the fund now, particularly where our employer contributions are reduced due to the legislation, and it just seems like we're in a just much more tenuous type of situation. I guess I'm just wondering how that plays into our, I guess in January, we're supposed to be looking at our allocation. So, you know, maybe some of that will be discussed then.
Yeah, so Angie, I agree. I agree what you're saying. The next, let's say year, what is this, 2021, right? it's only showing that we're supposed to get 600,000 back from what we've already committed, and we could potentially be asked, because these red numbers are not, there's either, they are capital calls. So potentially that's our exposure of 8.5 million that any one of these commitments could call. That doesn't necessarily mean they will call it. These funds are usually 5 to 7 years in they have the opportunity to call that money. So if we make a commitment for 10 million, they have 5 to 7 years to call that money down. And we don't know when they're going to give money back, and we don't, at any 1 year. And we don't know how much they're going to call in any one given year. So that's, again, when we're looking at our total portfolio, we have to look at the whole pie. And that's why I wanted us to have this meeting this month and next month instead of waiting, because we have to understand that this is just one part of the pie, right? And then we have the private equities, then we have the private debt markets, and then we have our portfolio when it comes to all the other managers that we look at on a monthly basis. And collectively, that whole pie is what we have to look at given our liabilities. And so while we got into this, and while Elm Tree was the odd bird around, because we gave them money and they turned around and started giving us money right away, which was good for us. But that doesn't necessarily mean it could repeat itself if we were to invest in them again. So yes, this is something that we thought we could do going forward at 15, maybe 15 million, 10 million a year. We'll just have to look at it when we look at our allocation, and then really our policy. And we set that policy as a board, and that policy dictates where we are going to allocate our money. So I think it's very good for us to look at this now, then look at the allocate the policy allocation next month. And then really, if we have to call another meeting just so that we're all comfortable in understanding where we're going to make those calls and those investment changes, if we need them, rolling up our sleeves for, January, February, March, and looking at where we're going to invest. So I told Lewis and Darnetta and everyone that educating us on where we are and where we need to be is very important now that our cycle is a little bit different. I believe that we also, and Sue, correct me if I'm wrong, in 2021, is that when we do our 5-year experience study with the actuary?
I know that it is coming up. I don't know for sure if it's next year or not. It's been a while, so I will check on that.
Right, and so that plays into our numbers as well. So so this is good if we have to have another meeting, just for us to be able to just do a little bit more education and dive into these. I'm more than happy to have another meeting just to get everybody comfortable on these decisions that we're going to be making in the next 1 to 2 years. So Angie, thanks for that.
Okay. Any other questions?
Kristen, can you go back up to where it showed Elm Tree, and you call it Big Fund, I call it Basis because that's how they present it to us. Not the name they called their fund, but I want to show, because Angie asked that question, where is it? Nope. Yes, this one. So in 2018, we gave Big Real Estate Fund,
Good.
which is Basis out of New York.
I don't really like them.
And we gave them $8 million, and we've paid in about 4.9. We still have 3.1 to give, but they've, out of the 8 million, they've given us 1 back.
Mm-hmm.
Right. So, I don't know what they gave, how much it was, for, is it 19 and 20? Let's just say it was $500,000 a year, who knows? But again, that, that's 2018. We're not going to this fund could go to 2025, Angie, per that cycle to see when we're actually going to get that full realization, and hoping that, you know, we gave them 8 and we're going to get back Y, right? To be able to calculate that return. Again, when we do these, they're long-term investments, and we don't have a clue when they're going to, you know, give us money in those 5 to 7 years. So we do lock up our capital and that we commit, but sometimes they don't take it all, like Kristen said, they don't take it all up front, and we just don't know when that capital will be committed based on their investment strategy.
So the point of this was really just to kind of go through the pacing plans, with the next steps being starting to bring forward to you managers for consideration. Okay. But we wanted to kind of set this plan out so we had our blueprint.
And Kristen, based on this, and just so that you and your staff can work, were you recommending like anything in real estate or private equity that we should consider even on a smaller amount? I know that credit is hot right now, but we've already invested in 2 of Monroe.
Right. So we would. Oh, I'm sorry. Go ahead.
Well, and I just want everybody to know that we do have a policy in place that says we don't want to give any one manager more than 10% of our portfolio. So, so while sometimes we always would like to go back to a manager who's done well for us or is doing well for us, we also have to take into account that policy restriction that we have. And I don't think that we're anywhere near any of those, except Monroe has got 2 of our credit portfolios, and that was, you know, something we probably would not be looking at them to go back to if that was the area we were looking to invest in.
So yeah, I mean, there is that dollar number, but then even higher than that, Monroe is going to be that private debt that we talked about. And so there's some other ideas that are far more interesting that we may want to consider. You know, I think Nexus closed, but something like Crayhill could be nice. Not only is it a strong firm, it's on our preferred list, Hartford based, but it's actually a Latino firm. And so, you know, to the degree we want to identify strong firms that fall into the diverse category, that's a firm that we've already vetted. We have a few others that could be interesting as well. So I'll look to see what might make sense. And then of course, on the real estate side, we have Elm Tree that's done a really great job for you all. Actually, Basis is coming, but Basis, also known as Big, is coming back to the market as well. We just got an update from them. And so again, those are some ideas, and there. So I will put something together to talk a little bit more about some of the, you know, the ideas. But safe to say, we're going to be more on the private credit side. We're going to be looking at distressed, European distressed, and niche credit. Ugh, niche lending. The nice thing is you just invested in niche lending with MC Credit. So we'll probably be looking at some of the more complex distressed, which Crayhill is one that falls into that. And then as it relates to the real estate, you have Elm Tree, you have Basis, and a few others that could be interesting also. So we will look at, you know, we'll bring forward some ideas that we would recommend you consider. We won't be able to probably do all of the managers that you could, but we'll find managers that make sense for your portfolio. And, you know, look, if you're talking about 10 or $15 million, that's probably, you know, 2 managers. Not sure that we want to go higher than that.
And did we miss Fairview Capital's fund?
No, I don't think we have. We haven't. I don't think we've missed.
That's venture, correct?
Yeah, that's venture. So that's going to be private equity. So you have Fairview. You have Grosvenor, which has a really nice advanced fund that also is rated 1 at NEPC, as well as it is a diverse manager fund. So that's interesting. And then you have Mesero, which you've worked with for years in the past also. And they have a fund. So there's some options on the private equity side as well. And so some of the managers are managers that you've worked with before, and there's nothing wrong. That's like, managers pride themselves on being able to get what I'm going to call repeat business, because it means you're truly a partner. And while you have investments with Mesero, it was when Linda was there. Linda George. I'm trying to think how long. It's been some years since your investment with Mesero. I'd have to go back and look. But my point
It was
being,
2008.
2008. I was thinking
Mhm.
7 or 8. So,
Mhm.
it's 2020. So
Right.
this is really wrapping down. But my point is, you have a nice history with them. So I think we have. I think you're going to be pleasantly surprised. We have some real nice opportunities for you all, and some of which are relationships that you've had in the past that I think we just we got a little stalled maybe in some of our investing. So we'll kind of move that forward. So
Thank you. I appreciate it. Look forward to those, and then we'll be able to combine that with our information that you provide us next month.
absolutely.
Do we want to take time, at least 10 minutes, to just go over the flash report if everybody's available?
I can do it in 5 if you like.
Okay.
All right, let me pull it up.
Thank you, Sue.
Excuse me.
Kristen, when you get a chance, can you send me the update on Basis? I'm not on their distribution list, and I don't get any information from them.
Sure. Okay. Yeah, I think it was just a note letting me know kind of where they are, but I'll find it and send it over. Wait, 1, 2, 3, 4, 5, 6, 7, 8, 9. 10. Is this almost? I guess because we're virtual, we really are doing well on the number of
Mhm.
people. I was thinking, like, what are we going to do when we go back to live? But our meetings are pretty efficient. I wonder though if people will fully go back to. I mean, after a year of remote. I don't know. Like some people, I have some clients, Christina, Hartford. I don't know if they're ever going to go, because we're getting a lot done in a quicker time, and you're eliminating some of the other
Nonsense.
Yeah.
That goes along with being in the office. Yes. The productivity rate is probably a little bit higher, I would say.
Mhm.
Maybe the sitting at the desk hours are a little bit different, but the productivity rate is probably a little bit higher.
Yeah.
Now, I cannot say for teachers. My heart goes out to trying to teach, from a remote area, and that face to face that the kids are missing. I would love for the kids to go back. Sometimes it's the only smile that they get to see during the day, and it's hard to see it and express it, and some, I have to say, my daughter loved getting hugs from her teachers when she was really young, and kids sometimes need that encouragement from an adult, and you can't do it while you're on Zoom, and 30 something faces are looking right back at you. So I'm really hoping that this vaccine, takes its course and we can get kids back into the classroom.
Yeah, I agree. I think it's going to vary by industry, and sometimes you do. Like, I don't want to never see you guys again, and that doesn't sound cool. But I'm just saying, as it relates to the productivity, because sometimes we weren't able to have people. They just couldn't make the meeting, but I feel like we've got a lot of buy-in here, so
Well,
that's
just
great.
imagine how much time you're saving not getting, run into the airport. you know, going through airports to get back and, you know, to St. Louis and back in the day.
Yep.
So,
Yeah,
mhm,
I believe we'll have a new normal.
mhm.
And it's been pretty efficient. And I think hopefully industries will take advantage of some of the efficiencies that has been gained.
Mm-hmm. Okay, well, let me very quickly go over the flash because we are now a little over an hour. And so I think we're doing great on the timing here. So if we can go to page 2. So what you're seeing is your, oh, you can go back. Yeah, go back. So this is going to, of course, be as of November 30th. So we have an 847 million. And that 806 is, they probably pulled that from October numbers, likely.
Mhm.
So we're a little bigger. But that said, let's just focus in on the managers here. You know, the areas that are a little, I won't even say problem children, but that have impacted your portfolio, maybe in a negative way since fiscal year to date, are importantly going to be Lomax. Lomax was down 8.9%. Fiscal year to date compared to the 1% of the Russell 5000. And then, of course, in the 1 year, down 7.1 compared to 1.7. Now, those are horrible numbers, but I want you to remember this is a point of time. Lomax has been your best performing manager for years. Like for the last 3 or 4 years, they've been in the top quartile. So their performance, things turned, you know, value went out of favor, and they've been really holding their own up until this last year, or really, yeah, somewhere right around this time last year. It felt like, I don't want to say things fell apart, but their names were just not working well for them, and so that gave some pretty, you know, dismal performance. They lagged considerably, and that's why you see it filtering out to the 3-year time horizon. But we don't think that they're broken. They've been a really strong manager, and the reality is no manager is just going to go up, 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 up. Everybody has their time of the sun and a little bit of a valley. So they're going through that valley, but we think that everything is still in place for them. If you scroll down to your large cap growth managers, they have, you know, kept up to as much as they could, I should say, to the benchmark. Growth, as you remember, has been so strong. And so when you look at the Russell 1000 growth, if you look right under Intech and you see 1 month, 10%, fiscal year to date, 32%, 1 year, 36%, 21% in 3 years, 5 years, 19%. Those are outstanding performance numbers, and that's the benchmark. So most managers are struggling to keep up with the benchmark. I don't want, while relatively, from a relative standpoint, you're trailing the benchmark, I just don't want y'all to forget that fiscal year to date, Intech, as an example, provided 28% return to your portfolio. TCW, for that same period, provided you with 37%. And TCW in the 1 year number was 41%. That's huge. That's unsustainable. And so, you know, see the forest through the trees, smile, we're going to take it. And there's nothing broken with these managers, even though technically when we look at the quarter, they're going to show that they're below the benchmark. But I want to just make that clear. So we can now move to the next page. Okay, your SMID cap growth was also on fire. If you see Russell 2000, 17% in 1 month, 23% fiscal year to date, 25%. So clearly you can see that obviously large cap did better than small cap or SMID, but once again, very strong numbers. It was a little difficult for some of the managers to keep up. Westfield didn't do so well in the 1 month, but they still gave you 11% return. So again, I'm not trying to be sarcastic. I just want you all to recognize that. On the fiscal year to date, up 27%, 1 year, 31%, 3 years, 18%. You know, I mean, this is just outstanding performance. When you look since inception, they've provided you at this point 10.4% over the 20 years that they've been working with you all. When you go down to systematic financial management, they're on the value scope. And so I'd love to point out to you, if you look at the fiscal year to date number and you look at their Russell 2000 value at -3%, that's the same time period as the Russell 2000 growth at 23%. That is a almost 2,600 basis point difference, huge. And so whether you were in value or growth was, very impactful in the portfolio. Up until the last month, November, we have not seen much positivity coming from value managers. It now looks like they're finally starting to turn the corner potentially. This is the first month that we've seen the Russell 2000 value higher than the Russell growth in, I don't know, a long time, over a year. And then you have DFA, they held their own. They're more of a kind of a value-ish, value core-ish kind of firm. So they're kind of hybridish. So that's your small, SMID. And let me speed this up. You have your international. International did well, but not as well as your domestic over the long term. As you can see, your total, again, for the month, 19.5%. So we are starting to see non-US come back. If you remember, up until this point, US has been the winner here, and if you see the fiscal year to date 1 year, you can see that the numbers are much different than what the domestic numbers are. Emerging markets also did well, 11% for the 1 month, 7.2 for the fiscal year to date. That's despite all the volatility. And then 14.2. And I guess I should have mentioned in your international, your managers trailed a little bit. For the Fidelity and Causeway was ahead for the month, but then did trail a bit on the other time periods. And I apologize, I jumped to EME before I finished that out. EME, when you look again at DFA and Invesco, Invesco is a relatively new manager. You've had them for about 6 years, and they've actually, for the most part, beat all their benchmarks with the exception of your 1 year number. They slightly trailed 17.9 versus 18.4, so we're pretty comfortable with them. And then DFA, of course, on the value side, the fiscal year to date, 1 year, and 3 years all struggled a bit more. They're also a quantitative manager. And so just trying to evaluate whether or not the characteristics that they're looking at will continue on a go-forward basis to be names that are going to outpace the market. So we're watching that. Nothing's broken. It's just trying to think about this on a go-forward basis. And then now you have your total global, that's exponents. And so they were able to do well for the 1 month, trailed slightly fiscal year to date, 1, 3 years. Remember, this was the old Progress portfolio. So all of these decisions were not theirs. The reality is, though, they are adding value to the portfolio. So I think we'll just give them a bit more time to show what their, how their portfolio style is going to be value add to your fund, excuse me. Okay. Fixed income. High level, fixed fiscal year to date, 7.3%. That's strong for your Barclays Ag and your total fixed income. Your 1 year number is also very strong. And you can see that most of that is in your fixed income and then your absolute return, which is Loomis. You see on that fiscal year to date that Loomis had about 9.5%. And then, your tips as well were a surprise. Look at that, 9.8%. That's huge. So we'll take it. It's likely not sustainable. So we'll be looking at some other areas. But in the meantime, we're happy to see that. Global multi-sector, that is a mixture. It's got high yield. It's got EMD. Didn't do as well because you see where the areas that did really well, which were what I'm going to call they were taking risk off the table, putting into things like core fixed income, tips, treasuries. And then you have your EMD blended, which did do well at 9%. And that's because it was both local and sovereign, which is like US denominated. And that was Lazard. So great to see that because they were up. Look at that, 9% versus 2.9. And I'm looking at the 1 year. The fiscal year to date, Lazard was up 6.3 versus negative 0.1%. So this is a little bit of a new manager for ish. I mean, you've had your managers for a while. So these newer managers have, I think you could say they've earned their keep and been some great decisions. So you can keep going. Your GAA, which is sort of a blend, that on the 1 year is 7.5%, fiscal year to date 4.6. Then of course 7.8. And so that's going to be your Mellon, GMO, PIMCO. We've talked about the fact that we're probably need to start to think about collapsing those managers. Not that they haven't done well, but are they doing anything differentiated to be in the portfolio, and do you need 3? And then your hedge funds, which is really going to be mainly your White Box and your Grosvenor. Grosvenor did very well for the fiscal year to date in 1 year. 1 year up 14%. White Box is struggling a little bit. They were flat for the month and down for the fiscal year 1 year. So they're a multi-strategy, so they have a number of different strategies embedded. So again, over the 5 years, they did 5%. So we'll continue to watch them. It's not that their performance is poor. You just have some other really strong performing firms on there across the board. So,
Kristen, can you do me a favor and find out what the status is of Entrust?
Yeah,
I know we're going to see that number negative as we go forward because it's only $1.5 million. That's
very
residual.
possibly, yeah.
It's
Yeah.
residual, and I don't know what it's invested in, and it's not invested in the portfolio. I don't recall. I can't remember what it was. It's one investment basically that's left. And I don't remember what it is, but when we look at that and we're going to see negative, it's because it's a residual.
Yes.
And I just really want to bring that to your attention so that we know and footnote it where we are and when can we expect that to come back, because it's been a while.
It has been. Okie dokie. All right, real estate, private equity, private debt, total cash. These numbers are really kind of flat. We're using previous numbers. We really use the private markets report, which come out quarterly. And then as a reminder, it's lagged by a quarter. So it's not much to report here. Okay. So a little longer than 5 minutes, but I think within the 10 minutes. Got a little carried away giving you all this information.
And Sue, did we close out LMCG 100%?
Mm-hmm. Yeah, that was done at the end of October.
Okay, great. So we have no residual coming there yet. Okay.
Yeah, we closed that out.
I just didn't see the last page to be able to go through to see if anything had come in, but I think I'm good. Are there any questions for Kristen?
Not for Kristen, but I guess for Sue. Sue, with the closeout, does that mean that we have sufficient money to handle the January bills?
Yeah, absolutely. Yeah.
Okay, though.
And we're anticipating the contribution to come in late December, early January from SLPS.
Usually that comes in the very end of December. But even if it's not here the very end of December, we have sufficient to cover the January 1st payroll.
Thank you, Sue. If there are no other questions,
I have a question.
Okay.
Christina, you start off and you said due to the shock to our system, talking about the investment was slow. So for the year of 2020, the overall of our portfolio did pretty well this year.
Yes.
Because I know you talk about the ups and the downs. So, but the overall total, our portfolio did well.
Yes.
Okay. I was just wondering because of the pandemic,
Yep.
I wasn't sure as our market was going down.
Yep.
Or
So
did
basically,
we lose money in our portfolio?
you
We
did.
did lose some.
Yeah, you did in March and April,
Mhm.
and then you regained. We've had
Okay.
some rallies. So yes, it was a different story in the summer, but we've really rebounded quite nicely. And so net, the portfolio is up.
Okay,
Kristen, can you
good.
show that on the first page?
Let's-
I just want to show Bobby where she was looking at, so she can
Yeah.
reference it.
So yeah, so if you look at that fiscal year to date, it's 6.4%. And most importantly, that 1 year number, and that's a rolling 1 year number. So 1 year, November 30th, 2019 to November 30th, 2020, you earn 9.2% in the portfolio.
Okay. Okay. And I think you say anything above 3% is excellent, huh? Or good.
Yeah.
Okay.
I mean,
Alright.
you know, we're a little trailing, but we've talked about that. And that's because some of those benchmarks are so high. But your actual rate of return, as Christina mentioned, is 7.5.
Okay.
So you're ahead of what you know. Actually, yeah, 1 year is ahead, 5 year, 10 year. Since inception, 6.9, 3 years, 6.3. But, you know, I think that, you know.
Good. Okay. Well, thank you.
You're
So
welcome.
Bobby, Bobby, I wanted to just show you that because when Kristen was talking about the COVID shock to the system, that's when we were talking about private equity and those companies being able to go and buy other companies to add to their portfolio. So some of those companies, depending on where they are, right? Like, you know, I don't think we have retail exposure, like, you know, but that's the COVID shock of maybe not being able to go out and find good companies to buy, right? So they may not call our cash because they don't need it. They're still looking for companies to buy. This, again, is the other half of the portfolio. And when we always talk about what the actuary report says, it says that we remember, I don't know if you remember, but we used to be at 8% expected, and we dropped it to 7.5. And we may have to drop that down a little bit further going forward. But if you look at that fiscal year to date is 6.4, and that, like Kristen said, and then next month when we look at preliminary Decembers, we'll know what the entire 12 months of 2020 looked at. And the stock market has been good overall this year. We had some dips, and remember we went through those numbers when everything was looking negative, you know.
Yes.
And, so always come back to this composite number, and it shows us our whole market, our total market value, and then look at where we are on that fiscal year to date number.
Okay, well, thank you.
So if there's no other questions, I'd like to, since this is our last meeting of the year, I want to wish everybody a Merry Christmas, Happy Hanukkah, season's greetings, you know, Happy Kwanzaa, you name it. I want to have everybody to have a blessed and safe holiday season with your family, your bubble, and we will touch base at the new year. But again, thank you everyone for being so engaged in these last 12 months with all our meetings, whether it was investments or just our board meetings in general. And I just want to say thank you. And I will pass it over to Louis to have any other words.
Again, to all the board members, Kristen and Sue, thank all of you all for being so supportive of our fund. And God bless all of you, and happy holidays to everyone.
Same to you all.
Thank
Happy
you.
holidays.
Same to everybody.
Thank you,
Okay.
everybody.
Enjoy.
Be safe and
I'll make
stay
a
well.
motion to adjourn the meeting.
Second.
A second.
Thanks, everyone. Take care.
Happy
Thank
holidays.
you.
Happy
Happy
holidays.
holidays.
Holiday.
Thanks, everybody. Bye-bye.
Stay safe.
Happy
Bye-bye.
holidays. Good meeting, Christian.
Bye. All right.
I hear somebody. I'm trying to end this and I can't. Just a minute ago, my computer went dead and I had to come
Yeah.
back to my iPhone. And now
Well,
I'm
I
trying to
could-
find out how to get out. You
Yeah.
just end it and I'll be ended, right?